If you're a U.S. citizen living abroad, you already know the deal. Your U.S. tax obligations don't just disappear. It's a pretty unique puzzle, right? So today, we're going to dive into a huge piece of that puzzle, Form 2555. Okay, let's just get right to the big question, the one every American living overseas has to ask. You're out there, you're earning money in another country, maybe you're even paying taxes there, so do you really still have to file with the IRS back home? And the answer is a big, resounding yes. This is the rule that changes everything. See, unlike pretty much every other country on the planet, the US taxes you based on your citizenship, not where you live. So that means your income, no matter where you earn it, is technically fair game for Uncle Sam. And that, right there, is the heart of the expat tax puzzle. So here's our game plan. We're going to break down the basic puzzle, then look at how you can qualify for a major tax break. We'll explore the two different paths to get there, and then, this is the important part, we'll get into the strategy of which tool is actually right for you before we wrap it all up. Now, for the good news. The IRS gives us a really powerful tool to help avoid getting taxed twice. It's called the Foreign Earned Income Exclusion, or FEIE for short. But, and this is a big but, it's not automatic. You don't just get it. You have to actively qualify for it by passing some very specific tests. Right, so it's a whole process. First things first, you've got to prove your tax home is actually in a foreign country. Once you've checked that box, you get to a fork in the road. You have to pick one of two paths, and then you have to pass the test for that specific path. Let's talk about path number one, the bona fide residence test. The key word here is bona fide. It basically means in good faith. See, this test isn't about counting days on a calendar. It's all about proving your intentions and what your life abroad actually looks like. At its core, this one's pretty subjective. The IRS basically wants to know, have you really moved? Have you set up a life there? Is this your home for the foreseeable future? Or are you just there for a temporary gig? It's all about the quality of your connection to your new country. So how do you prove something like intent? Well, it's all about showing you've put down roots. The IRS is going to look at stuff like, do you have a long-term lease on a home? Did your family come with you? Have you opened local bank accounts? Are you involved in the community? Like joining a gym or a local club. No single one of these things is a silver bullet, but altogether, they paint a very clear picture. Now, even though it's a subjective test, there is one non-negotiable, hard and fast rule. You absolutely must be a bona fide resident for an uninterrupted period that includes one full tax year. And we're talking January 1st all the way through December 31st. You can take short trips, sure, but your status as a resident has to cover that entire calendar year. Okay, so if the bona fide test sounds a little fuzzy, a little too subjective for your taste, don't worry. There's a second path that is way more straightforward. It's the physical presence test. And this one, it's purely a numbers game. Yeah, unlike that first test, this one has absolutely nothing to do with your intentions, your family, or your ties to the community. It is 100% objective, it's just math. The only thing the IRS cares about here is simple. Where were your feet on any given day? And here it is. The only number that matters for this test is 330. You have to be physically in a foreign country for at least 330 full days. And what's really great about this test is its flexibility. It can be during any 12-month period that rolls forward. It doesn't have to be a normal calendar year. But hang on, here's the little detail that can really trip people up. A full day means the entire 24-hour period. Any part of a day you spend traveling to or from the US, or even just flying over international waters, guess what? That does not count as a foreign day. For this test, those are considered US days, so you've got to track them carefully. So let's just put it all side by side. The bona fide residence test is subjective, it's based on your intent and your life abroad, and it needs that full calendar year. The physical presence test, on the other hand, is totally objective. It's just a day count, and it needs 330 days in any 12-month stretch. The good news? You only have to pass one of them. Okay, so let's say you've passed one of the tests. You qualify. You can claim the Foreign Earned Income Exclusion. But that brings us to what is maybe the most important question of all. Should you? Because the FEIE isn't your only play. You've also got something called the Foreign Tax Credit, or FTC. So here's the general rule of thumb. The choice between these two strategies almost always boils down to one thing: the tax rate in the country where you're living. If you're in a place with low or even zero income tax, the FEIE is probably going to be your best friend. But if you're in a high-tax country, the FTC is often way more powerful. Let's make this real. Meet Rachel. She's a teacher in Qatar, which has zero income tax. If she uses the FEIE, she can just exclude her income and boom, she owes zero US tax. Simple. But if she tried to use the foreign tax credit, well, she hasn't paid any foreign taxes to take a credit for, so she'd still be on the hook for about $4,000 to the IRS. For her, the FEIE is a total no-brainer. All right, now let's look at David. He's a consultant in Germany, a country with pretty high taxes. He actually pays more in tax to Germany than he would owe in the US. So with either the FEIE or the FTC, his final US tax bill is zero. But, and this is the key difference, by using the FTC, he keeps his eligibility for refundable credits, like the child tax credit. And that allows him to get a $3,400 refund from the IRS. That's cash back in his pocket that he would totally give up if he chose the FEIE. And that really shines a light on the hidden trade-offs here. When you choose the FEIE, you're giving up those valuable refundable credits. But it gets even trickier. The FEIE is a sticky decision. If you choose it and then change your mind later, you're generally locked out from using it again for 5 years. That's a long time. So you can see this as way more than just ticking a box on a form. It's a real strategic decision that can affect you for years to come. Let's just quickly recap the key things you need to think about to make the right choice for you. Ultimately, it's about looking at your entire situation. What's the tax rate where you live? Do you have kids under 17 who qualify for those credits? What's your income look like? And what are your plans for the next few years? The right answer for you is buried in the answers to those questions. And that really leaves us with the one last question you have to ask yourself. Because of that 5-year lockout rule we talked about, the choice you make on your tax return this year, it's not just about this year. So the question is, are you just solving today's tax problem? Or are you building a smart strategy that's going to work for you over the long haul?